So today we're going to talk a little bit about the real estate downturn that we have just experienced and hopefully are at the bottom of. And just for a little bit of context, we saw the largest rate hike in Fed history, and that rate hike resulted in an immediate decline in real estate values because real estate is a levered asset, uses loans, and because cap rates fluctuate with interest rates. And so as cap rates go up, values go down. So over the last, call it 3 years, we've seen about a 15 to 20% decline in real estate values, which equates to about a 30 to 40% decline in the equity value in real estate. Mm-hmm. The largest decline we've had since the Great Recession. So just framing our conversation here today, we've gone through a pretty significant market decline. And what are some of the key lessons that we've learned from that?
Yeah, there's a bunch, and it's mixed. We'll talk about it a little bit later, but this is almost like a series of 100-year events. And it's caused a bunch of distortions that are different from the GFC. But I'll start by one that's similar in that downturns take longer than you think. Yeah. Like the real estate cycles are a thing. 5 to 8 years during the GFC, the downturn was from about 2007 to about 2011, 4 to 6 years. In our case, it feels a little compressed in that it seems like this started about mid-2022. Today, we sit near the end of 2025. Yep. It seems like we mostly invest in apartments and multi-tenant industrial, and it feels on the apartment side that we've bottomed and recovered and began, maybe we're 10% off the bottom in the markets we serve. And frankly, this is, I think, common throughout the U.S. And on the industrial side, things still seem to be settling out. Maybe we are 10% the other way. We're not on the recovery part, we're just before. What's interesting is, that cycles take longer than you think. And while you need to plan for those, as we'll talk about, pencils down isn't always the approach. Uncertainty creates opportunity.
Yeah, it's interesting because as many people say, if you could predict market cycles, you'd be a billionaire or a trillionaire because being right but being wrong on time is as bad as being wrong. Mm-hmm. You know, you can, if we attempt to time the market, we end up with lost opportunities on the one hand, and we end up with, opportunities we wish we hadn't purchased on the other hand. So there is some wisdom to that kind of almost dollar cost averaging where, during market cycles, we are aware of the market cycles, we're factoring in the market cycles, and we're using that to make the best decisions in any moment in time.
An interesting piece of that, though, is that this market cycle acknowledged its distortion in some way. This was a sort of an artificial cycle. It was a COVID-driven, money went in, now we got to recover from it. When you look at the real estate charts from 2011 to today, you often see, an inflation level up and to the right kind of growth in value in line with rents. But when you look at the charts in COVID, values flooded up, and then interest rates flooded up as well, and then values went down to match interest rates. But it wasn't a one-for-one. Interest rates went from 3.5% to 6.5%, sometimes 7.5%. And yet cap rates moved, 1%, 1.5%, which is still, a 15 to 20% value decline. But there's this secular trend, or there's this, secular in that it's unattached, which is that America is chronically undersupplied for apartments. There are millions more apartments needed than exist, and so there's a durable demand line that is there and continuing to grow. Also on the industrial side, distribution and e-commerce continue to be major trends driving need for that. So unlike the GFC, where it was kind of like values collapsed and buildings were vacant and businesses were falling apart, the need for these two asset classes was still high. So you had the mix of demand was still a thing, but risk-adjusted returns reacted in a muted way because of the durability of the asset types, even with interest rates being higher. It's a mixed bag is the point.
One of the other things that we saw during the downturn is really a preference toward cash flow, which is not surprising. This is typical during downturns in that as we're going through the upcycle, we are more and more willing to bank on the future and less need to have return now because we get to this kind of exuberant stage. And so then we're much more focused on, well, if I add value, I can create this value. If I add value, I can create this. And if I don't have as much near-term cash flow, that's okay. As we've seen through this downturn, collectively the market's preference for current cash flow has increased significantly. Not to diminish the value add, because we are still seeing today, value add returns that are very strong, stronger than they were 3 years ago. But on top of that, you have this cash flow component that really it adds safety to the return that you didn't have when you were in this more exuberant phase.
I think it was firms are a collection of their people. They're a collection of their lessons learned, both from the people and as a firm. I think this was a real chance for our firm to mature or learn a new series of lessons that will endure with us. But, as you said, prior to 2022, cap rates cap rates were very low. I mean, things were trading in the fours, and especially on the value add side, maybe high fours, but you weren't buying stabilized properties. You were buying, an opportunity set. And the seller was participating in some of that value, and the market allowed for that. The lesson learned in this is that cash flow endures, and that, it's that Warren Buffett idea of when the tide goes out, you see who's wearing shorts. But the point is, value add is amazing, but it's also very cyclical, and cash flow is I strongly believe that it will be cash flow will be much more valued in this firm for the long term, even as we go through the next cycles.
Yeah, and cash flow brings safety. I'd say one of the other lessons learned, fortunately not as hard of a lesson for our firm, but one of the other lessons learned is the value of fixed rate debt. None of us expected the magnitude and swiftness of the interest rate hike. And so even we as a firm are dealing with the fact that as assets refinance, the interest costs are significantly higher than they were, prior. But then obviously the firms that used more variable rate debt, they saw that almost immediately.
They're blasted.
We at least are sheltered in the sense that, the duration of the loan allows for a little bit more of the market to settle out to be able to accommodate that higher interest rate. But certainly debt and debt structure becomes amplified when you're in an environment where interest rates are elevated.
One new phrase that came out of this downturn was that, I don't hear it anymore. I haven't heard it in about a year, but pencils down. Everything was I kept hearing pencils down. And first I'm like, who writes with pencil? I mean, I don't know, but pencils down. Everybody was pencils down for a couple of years. And two parts. Number one, it speaks to the herd mentality and how in uncertainty, there's some famous sentiment about letting things settle out and then letting things start again, which is about where we're at now. But I look at the Elk Grove deal, I look at the Loft deal, I look at Tilly Lewis deal. I mean, frankly, we're sitting out in Fund 4, but I look at the 8 deals in Fund 4 right now, all bought during pencils down, and think, thank goodness we bought during pencils down. Yeah. I mean, pencils down also means uncertainty. In the markets we serve, we were liquidity at a time when some needed liquidity. And frankly, now is a magic moment. Into 2025, we both have clarity. We have a sense that in 2026, the market's going to firm up. I listen to other firms' podcasts, some large firms. I hear sentiment echoing this, and I'm thinking let's keep buying while we're in this trough, while there's a lack of liquidity, and we're able to execute because increased activity is coming.
Well, and I think that goes back to the idea of instead of we're on, we're off, it's much more around the idea of a lever. When we perceive that, borrowing from Howard Marks, when we perceive that the probability of further downward is low, that's the time that we should be more active buyers. When we perceive that the probability of downside is high, as we get higher in the market, that's when we should be less active. But there are opportunities all along there. And I would say even some of the assets that, in hindsight, we say, man, we shouldn't have bought that asset at that time of the market. We still bought well relative to that market. The challenge that we're working through is that asset now has to go through this decline, and then we have to get back up to, a better market cycle. But I think the key is to be buying the right assets and at varying velocities depending on where the market is in its cycle.
If I were to generalize, it would be do the opposite. In 2022, when everyone was chaotically buying, we bought at a discount, we followed our process, but those prices have come down and are going through a trough and a recovery. But during the pencils downtime, we got smoking deals. And almost always the answer is don't do what everyone else is doing in investing, because almost always that's beta. Alpha lives in uncertainty. Silence equals alpha. So, there's a very powerful lesson there about if you feel a little nervous, break that down and ask why. And if you feel a little safe, break that down and ask why.
What are some other lessons that we've learned during this downturn?
The ability of... What's that old saying? Never underestimate how long the market can outlast your good idea. Mm-hmm. Well, the point is, in a downturn, when you think things are difficult, expect a pile on. When bad things pile on, they do. I suppose the reverse is true also. But in a negative situation, you have debt costs spiking. Guess what? Then insurance. Mm-hmm. Then labor. Then materials. Mm-hmm. Then you have this wall of maturities. It's like. In capitalism or in market forces where there is opportunity for anything, it will move.
Yeah.
And add in now potential stagflation or recession or a sustained, market rates higher for longer. It feels like the tide is turning, but never underestimate the ability of all market forces to converge right at once.
Yes.
Because they will. Any thoughts on that?
It reminds me of thinking about how assets, individual investments respond to those market forces. Because I think we've also developed a sentiment over time where we don't want to be owning assets that can be more, the magnitude of the problem can be amplified. And one thing I'm thinking of is, the move away from single tenant assets, large anchor tenant assets, because those are the assets that can be most impacted by changes in tenancy. Whereas the assets that have broad diversification, they have a general ability to maintain cash flow, to maintain occupancy better than where we need to have that anchor tenant.
That might have been the biggest lesson learned, to restate what you said in my own eyes. It is avoiding binary outcomes and creating optionality. It's not cash flow or value add. It's cash flow and value add. It's not... your debt needs to have, if you have cash flow, you have debt optionality. The point is, be in a location where you have multiple groups that could take you out. The private owner, the syndicator, the institutional. But in everything we do, seek to have optionality. And, then you have time optionality, you have capital optionality, then you can scale. There's no crises when you have options.